Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today's Thursday, September 1st, 2022, and this is our monthly market monologue. We're obviously going to take a look at the stock market. We're going to talk today about some of the comments from Federal Reserve Chairman Jerome Powell, and we will also talk about or answer some of the questions that we've been getting from clients, in particular regarding trade confirmations and what we call whipsaw. So we'll explain all of that. So let's just dive right in. Before we go too much further, I need to pause because I usually forget to do this and encourage everybody to be sure that you've subscribed to our YouTube channel if you haven't already done that. And while you're over on YouTube, we would love it if you would hit the like button there on YouTube and then maybe even leave us a comment. All of that does help the algorithms so that others might find these videos. Same thing on Facebook. If you're on our Facebook page, please make sure that you've liked the page in particular, but even further, liking the various posts that you see, especially this one, and maybe even leaving a comment there. And again, naturally, feel free to share these videos, our social media posts, etc., with others. As we go through this particular economic and stock market climate, more and more people are reaching out and searching for an advisor, and we are growing and we have capacity, and we would love to have the opportunity to meet others that you might know and might find value in working with us. So that selfish plug being done, let's look at the data. And on the screen right now, we have a screenshot, if you will, from BEA.gov. That's the Bureau of Economic Analysis .gov. And on August 25th, they released the revised data for GDP for the second quarter. And the good news is they revised the data up, so that is good news. The bad news is that the revised data is still negative. So now we have 2 consecutive quarters of negative GDP. You can see it here. We've got the first quarter and the second quarter, and we'll show it again here on our chart where, again, 2 quarters in a row of negative GDP. Historically, 2 quarters in a row of negative GDP signals a recession. There is some debate in the academic circles as to whether or not the National Bureau of Economic Research will declare that we are already in a recession or not. We have been saying that we are, and we're going to talk a little bit about how it certainly seems like it might very well get worse in terms of the economic data. Why do I say that? Why do I say that the economic data appears that it might actually get worse? Well, let me show you why. On the screen right now is some excerpts from Federal Reserve Chairman Jerome Powell's speech that he gave on Friday, August 26th to the Jackson Hole Symposium. And we'll highlight a couple of things. Notice I have emphasized some words when he's delivering the speech, and you can watch the full speech. It's only 8 minutes. You can watch the full speech on YouTube if you so desire. But when he delivers a speech, it's fairly bland. But I think it's important that we call attention to some of what he's saying, and the overall stock market absolutely called attention or latched on to some of what he said, and I'm going to show you that on a chart. So here's what he said. Restoring price stability, that refers to inflation. We'll look at inflation. Inflation has been high. We've been looking at that all year long. It has indeed come down a little bit, but not much. I'll show you that in a second. So when he's talking about price stability, he's talking about inflation. Restoring price stability will take some time and requires using our tools forcefully. Now, again, I'm adding emphasis. Requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Now, again, what's the trend? The trend for the last 2 quarters has been negative GDP. So they haven't been incredibly negative. It's barely negative. I think the first quarter was negative 1.6, and the second quarter was negative 0.3, if memory serves me correctly from the chart. I've already forgotten what the chart said. So that's not significantly negative, but it seems to me what Chairman Powell is saying, it's likely to require the changes that he and the Federal Reserve are going to do in terms of raising interest rates and quantitative tightening, which we probably won't get into today. But reducing inflation is likely to require a sustained period of below trend growth. That doesn't sound like the economy is going to be growing. It sounds to me like that he's forecasting the economy could very well be contracting even more because he's saying below trend, and the trend the last 2 quarters has been negative. So he goes on and he says rate increases. Again, the rate increases he's talking about is the overnight lending rate, which has a almost a direct correlation to just about every interest rate throughout the economy, whether it's a credit card interest rate, a new mortgage interest rate, or home equity lines of credit. If you have a home equity line of credit, our encouragement would be to really focus on paying that off as quickly as you possibly can because of all of this. So he says rate increases will also bring some pain to households and businesses. These are unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. So again, whether you are running a business or you are just running your family's budget, he's forecasting more pain. We've already experienced some pain in terms of the inflation, but he's suggesting that it very well could get worse. And what that also suggests is, again, there's a possibility of layoffs. So depending upon if you were working or you're retired or whatever, but if you're working and you're working for a big organization, small organization, as you are thinking about your next 6, 12, 18 months, you need to think about how secure your job is. How secure is the company? And again, if you have any specific questions in that regard, reach out to us and we'll be happy to spend a little bit more time diving into your particular situation. So good news, bad news. Chairman Powell says we will keep at it until we are confident the job is done. One of the concerns that many people have had is that Chairman Powell is going to hit the pause button and they're going to stop raising interest rates because we are experiencing economic pain. Again, there's reasons why people have been saying that, but I'm glad he made this comment. We will keep at it until we are confident the job is done. I particularly don't want him to raise interest rates to try to lower inflation. Then we see a recession, which is kind of what he's predicting here. And then he says, well, there's a recession. Now we got to lower interest rates again. I think that just prolongs the problem. So I like the fact that he said we will keep at it until we are confident the job is done. But again, it's likely to require a sustained period of below trend growth, and it is likely to bring some pain. Now, how did the stock market react to this? Let's take a look. Okay, this is the SPY ETF. SPY ETF is an exchange-traded fund. SPY is designed to mirror the S&P 500, and on the screen right now is a 1-minute chart. So every one of these candles, this is a candle chart, every one of these candles represents 1 minute of trading on the S&P 500 or the SPY ETF. Again, 1-minute chart. Chairman Powell started speaking here. He stopped speaking here. So as he's speaking, the market's going down. Midway through the speech, people are saying, no, this is not that bad. But then people are starting to really think about what he actually said. And you see this market is actually selling off. I'm going to flip it to a 5-minute chart so you can see the full day. Again, this is where he spoke. And as soon as he's done speaking, the market is just selling off. And 4 o'clock right here is when trading ended. And this is after hours traded technically. So that's Chairman Powell and Chairman Powell's speech, and what he is projecting is more economic pain. So I'm going to try to pick up the pace just a little bit. And on the screen right now is CPI, the Consumer Price Index. Again, it's at 8.5 is the latest stat. It has come down a little bit, but we do not expect it to come down significantly over the next couple of months in particular. And one of the things that I do on a regular basis is read other analysts. Martin Pring is one of them. He's very well respected for his analysis. And so one of the things that he said in his monthly research that I was reading last night is that he's expecting inflation to remain a problem for the next decade and a half or so. So who knows if he's right, but I can certainly understand why he says that. And we've been saying some very similar things, that it is entirely possible that we're going to be struggling with higher than average inflation for quite some time. Might not be doing 8.5%. Might get down to 7, 6, 5. I don't know. I'm not predicting where inflation is going to go, but I'm not thinking we're going to see a return to 2% inflation anytime soon. So that pain that Chairman Powell was talking about, I do think is going to be here for a little while. So real quickly, this is the federal funds rate. We're currently at 2.3%. Chairman Powell and the Federal Reserve Committee has talked about getting to at least 3% before the end of the year. They are meeting again in the month of September, so I would not be surprised to see them raise the interest rate up to 3% then. So again, according to Chairman Powell, the Federal Reserve is going to use their tools forcefully, and it is likely going to cause the economy to experience a period of below trend growth. And we already showed you that the latest trend has already been negative. So what does the bond market have to say about this? Many people have said over the years, and I've certainly discussed it in some of these videos, is that the bond market, in particular the yield curve, does a relatively good job of forecasting whether or not we're going to experience a recession. We've talked about in particular how we like to use the 10-year minus the 3-year. That is the yield curve that we prefer to look at. So on the screen right now is that chart. It is the yield that you would get on a 10-year Treasury bond minus the yield that you would get on a 3-year Treasury bond. And the yield curve is said to be quote unquote inverted when the yield curve goes negative. So again, we see back in late 1980s, the yield curve definitely went negative, forecasted recession. Leading up to the end of the dot-com era, this is the year 2000. Here's the yield curve going negative. Here's a recession. Yield curve goes negative in 2000, looks like 5 and 6. Here's a recession. Look at where we're at. Again, this yield curve here, 5 and 6, forecast in the 2008 recession. Many of us remember that recession very well. Now, that said, I'm not predicting that the upcoming recession, if we're not already in one, is going to be as bad as the 2008 recession. I'm not necessarily saying that. But if a minor yield curve inversion predicted this recession, what does this yield curve inversion predict? So it seems to me that the 10-year and the 3-year yield curve is indeed forecasting a recession. And if we zoom in a little bit, this is the same yield curve. I've just zoomed in. Again, this is 2020, 21. 21 is right here, actually. So here's this yield curve zoomed in a little bit more. Certainly looks like it is negative, and it does not look like it is coming back and recovering just yet. So again, trying to pick up the pace a little bit because we still need to answer the question that some clients have been asking about trade confirmations, and the term that we used earlier is whipsaw, and we're going to define that for you. But first, let's take a look at how difficult this year has been. On the screen right now is the S&P 500. Every line represents a different year, dating all the way back to 1976, because that's the year I was born. That's when I pulled the numbers from. The big, bold red line, that's where we're at year to date. That's us. That's current. So the only year that is worse than the current year, as of this date in the year, is 2002. So 2008 definitely ended worse, but at this point of the year, 2008 was actually a little bit better. So switching to midterm years, what happens in a midterm year when the president is not on the ballot, but Congress is? And so this is the midterm years. This dates back all the way to 1974, so it's every 4 years dating back to 1974. And again, you see 2 years that are worse than the current year, one of which, of course, is 2002, because we just said that. So then we look real quickly at the second half of the year in those same midterm years. So if you reset the clock to 0, or reset the index to 0 on July 1, and say midterm years from July 1 to the end of the year, how does that look? 2022 looks a little bit better in that regard. By no means are we predicting that the market is going to be fantastic between now and the end of the year. This is 1982, by the way, a 52% rate of return in the S&P 500 from July 1 to the end of the year. That is fantastic, and I certainly do not think that's going to happen this year, but would love it if I'm wrong. So anyway, that's year-to-date returns. Now, one more thing that we want to look at before we talk a little bit about some of what clients have been experiencing, and the term whipsaw is, again, how difficult has this year been? On the screen right now, there's 3 lines. You've got the green line is the S&P 500 as measured by the ETF that we were looking at earlier. It's SPY. So the SPY ETF year-to-date as of the end of the month is negative 17.3, 17.28. And then we've got TLT. TLT is a 20-year, it's a long-term bond, and year-to-date, that ETF is negative 22%. So you've got both stocks and bonds very heavily correlated. Usually, what most people expect is when the stock market is down, the bond market is up. This chart is clearly showing us, as we've discussed all year long, that the stock and the bond markets this year are very heavily correlated. There's been some deviation here recently. This is actually good news that we're getting some separation from this. However, what I'm trying to show in this chart is the red line is the 60-40 version. So if you put these two ETFs together, put 60% in the equity portion, you put 40% in the bond portion, what would that portfolio look like? Well, a 60-40 portfolio is typically, you can call it a lazy portfolio or a buy and hold, just throw it in that and let it ride, it'll all work out in the end. Well, again, that 60-40 allocation is negative 18% year to date. That is a very difficult year. So what I want to switch and talk a little bit about now is some of the whipsaws that we have seen in the stock and the bond market. So on the screen right now is the S&P 500, a monthly candle chart, just trying to show how violent the month of August was. Top to bottom, it was about an 8.5% decline. So now we want to switch and we want to look at the daily chart so I can explain what is a bear market, number one, and number two, what is a bear market rally, and number three, what does the term whipsaw mean and why does it then generate a bunch of trade confirmation? So first question is, what is a bear market? A bear market is when the market is moving down. It's as simple as that. So a bear market rally is when the market is rallying within a bear market. So the market is moving down. There's a minor rally, but in general, the market is moving down. There's a minor rally. In general, the market is moving down. Well, the point is that some of these rallies can be very exciting, very enticing, and they're quite violent. So again, back in March, we had an 11% bear market rally. So it looks great, but that rally fails. It is not sustainable, and the market falls, and then sometimes we'll create a new low, and that is certainly what happened here. The market fell. There's a mini attempt at a rally, didn't last very long at all. This is another attempt at a rally, again, found some resistance, and we ultimately put in the ultimate or the new low for the year. I hope it's the ultimate low, but that it remains to be seen. So again, in the month of July, we really see this nice rally, effectively 18% rally, where we rose, we kissed the 200-day right here, and that rally then failed. This big black candle, that's when Jerome Powell was giving that speech at Jackson Hole, which we already talked about. So that's what a bear market rally is. Now, the point is that's also then going to create whipsaws. And a whipsaw is where the market is just moving in one direction, then it gives you a whipsaw, it jerks you right back down. It's going up, it jerks you right back down. It's going up, it jerks you right back down. That's whipsaw. Now, one of the things that we have been talking about and we'll explain again here is we use what we refer to as a multi-strategy investment approach. Now, the language that I'm going to show you on this slide, and then there's one more, is actually embedded in our draft, what's called an investment policy statement, which are going to be rolling out in the coming week or month or two, sorry. And so one of the things that we're describing in that multi-strategy or in that investment policy statement is what is a multi-strategy investment approach. And it is simply us recognizing that there's no such thing as an investment strategy that works 100% of the time. Therefore, what we do is we employ multiple investment strategies that are combined into one cohesive framework. And so one of these strategies that we're going to talk about right now is quantitative. All right, so real quickly, this is how we are taking all of those strategies that I just briefly touched on, and we're rolling them into one cohesive strategy. So a client account is going to be invested in one of these models, and that model is comprised of multiple different strategies. So each color represents a different strategy. Now again, one of those strategies is called a quantitative approach. So what is a quantitative model? A quantitative model is really just a model that is using a definitive set of rules. So you can think of it as if-then rules. If this is happening, then do that. If this is happening, then do that. The point about a quantitative model is you can back test it. So when we back test a model, we can say, well, I wonder what would happen if we bought here and we sold here. And every time this indicator did that, and then this indicator did that, what if we bought and we sold based upon those rules? Now, when we design a system like that, we can then put it through a backtesting program and refine it. We're very careful not to curve fit it, and we won't get into what that means. But the point is, we can backtest a quantitative approach. And when we design something like this, then our job is to simply follow the rules. And that's effectively what's been happening. I think it was 2 weeks ago where our quantitative model gave us multiple signals in the same week. And our job, if we have confidence in our quantitative approach, and if we have confidence in our quantitative model, our job is to follow the model. If the model says buy, we buy. We don't question it, we just buy. And if the model says sell, we sell. And we're not questioning the model because we have confidence in our backtest results. So that's what has been happening in our quantitative model, which is only one of the models that make up an overall client account. One of those models, one of those strategies was kicking off a lot of signals. Buy, sell. And our job is simply to follow the rules. And that's what we did. And so that kicked off a fair number of trade confirmations, and some clients were asking, hey, why am I getting them? It's simply because we're following our rules. There's, again, no such thing as an investment approach that works 100% of the time. And what just happened in the month of August is what we refer to as whipsaw. So one more point that I want to make, and this is really important, and we'll wrap up for the day. Going back to what we were just discussing, the whipsaws and the quantitative model and the quantitative rules. The quantitative model is only one portion of the client's accounts. And so if you are a client of ours, that quantitative model is only a sliver of the pie that makes up your account. So that's the first thing. The second thing is there are no transaction costs when we are implementing those quantitative rules. So one of the questions that we got last week from a client, longtime client, so I really appreciate the question. No, there are not transaction costs when we are implementing those rules. That is part of the reason why we like this approach, is because we are living in a transaction-free environment for the most part. So when we're implementing this quantitative model, it is designed around an approach that allows us to implement it without the client incurring a transaction cost or a fee or a commission or any of that stuff. So that was a really good question by a client, which reminds me, if you have any questions, whether you're a long-time client, a first-time client, or you're not even a client, by all means, feel free to reach out to us. Our website is on the screen now, hicks-associates.com. We do read the comments on our Facebook page and our YouTube channel, so by all means, you're welcome to reach out to me. I'll also throw up my email address for you. We appreciate you watching, especially all the way to the end. Again, we do ask that you like the video and subscribe to the YouTube channel. And again, thanks for watching. We hope you find it helpful. And again, do not hesitate to reach out if there's anything we can do for you. You do not need to be a client. We would be more than happy to see if we can be of service. Again, thanks for watching.